Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is about the currency markets, in particular the US dollar index, the Canadian dollar, and the euro dollar. Those are the ones we're going to focus on here today to determine what impact, if any, they have on grain prices. So our topics today include factors that affect currencies, market psychology, fear and greed factors, US dollar index versus the euro dollar, and then protecting yourself against a rising Canadian dollar. Our first topic today is about the factors that affect currencies. Currencies are difficult to predict at the best of times. A currency's value is determined by supply and demand for that currency. However, that supply and demand is not influenced by one single factor, but by many. Three factors come into play. Number one, economic climate. Two, political climate. Three, market psychology. Let's talk about economic climates. Economic policies such as GDP, interest rates, money supply, employment figures, trade balance figures, inflation, budget, surplus, or deficit can all have their spotlights in the short term. A more healthy economy usually equals a better performing currency, which increases demand. Higher inflation equals a lower currency value, which usually leads to increased purchasing power, which is equal to higher demand. Higher rising interest rates usually supportive to currencies and equates to a higher rising currency. Internal, regional, and international political conditions can have a major influence on currencies. Political instability and upheaval usually equates to a lower currency, while a fiscal responsible government will equate to a higher currency. Our second topic today is about fear and greed. Fear and greed can sometimes send markets to extreme situations, either to overbought or oversold conditions, as the media puts out headlines that usually make it more than it actually is. It's never as good as you think it is. It's never as bad as you think it is. In times of crisis, many investors will flock to the US dollar index as a flight to quality because it's the global reserve currency. At other times, markets may buy the rumor, sell the fact, and vice versa. Our third topic today is about the US dollar index versus the euro dollar. Let's look more closely at that US dollar index. It's the most widely recognized global currency in the world. US dollar index tracks the US currency against 6 other major currencies. The major one, or the biggest percentage, is, or the largest weighting, is the euro dollar at 56%. The Canadian dollar comes in around 10%. Many commodities are priced in US dollars. Therefore, a lower US dollar increases the purchasing power of foreigners buying of that US commodity. This leads to an increase in demand of exports for that commodity. The opposite is also true. When the euro dollar is falling, the US dollar index is rising and vice versa. You can see it in the chart that I've provided. There's a huge opposite correlation there. However, over the short term, sometimes these spikes and falls can be short-lived. Try to ignore the daily ups and downs. I call that noise. A European debt crisis in 2010-11 was a good example, which caused the euro dollar to fall on fear of a recession. It has since recovered as the economy has improved and strengthened. Our fourth topic today is about why and how to protect yourself against the rising Canadian dollar. Canada has a wealth of resources such as gold, oil, etc. Demand for these commodities or resources in the past decade have supported a higher Canadian dollar. You can see it from the chart that I've provided over a long period of time. A higher Canadian dollar equals higher priced commodity products, which equals reduced demand and exports for those commodities. A good example is the rise in the Canadian dollar from 2002 to 2008. It can lower a livestock producer's bottom line. It can also impact a grain producer's basis by as much as 2/3 in Ontario. It has less of an effect in Western Canada. During this period, a hog producer's bottom line could have dropped by $45 per head, assuming hog futures at $80 per carcass. The local basis on corn in Ontario during this period widened to a minus $1 per bushel. Of course, a falling Canadian dollar can have the opposite effect and create a positive basis or a better basis for a grain producer across Canada and increase a livestock producer's bottom line. A rise of $10 in crude oil can also add as much as 3 cents to the Canadian dollar. Therefore, hedging the Canadian dollar at the right time can add value and more dollars into a producer's bottom line. Our fifth topic today is about how and where to hedge the Canadian dollar. Let's start off with how do you hedge the Canadian dollar? Well, there's 3 ways you can do it. One is you can go long, you can go buy futures on the Canadian dollar. Each contract covers 100,000. 2, you can buy call options on the futures. Or 3, and this is my preferred option. You can purchase a forward derivative product offered by financial institutions such as banks, credit unions, Western Union to help manage the margin call on futures. When trying to project forward or predict the Canadian dollar and where it's headed in the future, use the Dow Jones Industrial Average. Why use that? Well, you can see from the chart that I've provided that there's a huge correlation, actually an opposite correlation. When the Dow is rising, the Canadian dollar seems to be falling and vice versa. There's always an exception to the rule. In general, Canada is the U.S. largest trading partner. Good news from the U.S. is usually good news for Canada and the Canadian dollar. In summary, currencies have a large impact on grain prices and can add volatility both in the short term and long term. Understanding the many factors that can influence a currency and ultimately its direction can assist in knowing the direction of grain prices over time.